Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Welcome back to the Risk Intel podcast. I am very excited to continue the conversation with the Chief Growth Officer at SRA Watchtower, Niki White, today. Niki, thanks for being with us.
Good morning, Ed. It's a great day.
Niki, in your prior life, you have worn the hat of being an auditor, being a risk officer, being inside of a bank, as we've talked about in prior conversations. And in our last discussion, we drew on some of that experience and your experience on cultivating a culture of risk inside a financial institution. And so today, I'd like to build on that and explore the impact of cultivating a culture of risk on an institution's efficiency, strategy, and shareholder value. So in our prior episode, we discussed what it means to establish a culture of risk, right? Why this culture can be more than simply the land of no. And what are some of the drivers that form and influence a culture of risk, right? We talked about the tone at the top, accountability throughout the organization, encouraging effective challenges, aligning incentives, and ensuring that there's awareness of risk throughout the teams. Switching back to today's theme, culture is often thought as purely a qualitative attribute. And I think that theme probably kind of permeated our prior episode, but today we have three examples which illustrate that a culture of risk can really be quantified and have a quantifiable impact on an institution. So let's get into these three topics today. Let's start with the question of efficiency and what processes such as hidden factories, for example, indicate about the culture of risk within an institution.
So when we think about hidden factories, there's a few different items, unplanned inefficiencies, and how are those aligning, and what does that do for your culture? So is your culture one of swimming through a sea of Excel spreadsheets? Does anybody really know who owns the data that goes into the various reports? We had one example, I think we maybe even touched on this in our hidden factories podcast, of we were working with a client that was trying to trace a number back so that they could incorporate that into their newly built risk program. And they ended up talking to 12 different people and still didn't find out where the number originated from. And if we really lean into that one element from a risk perspective, that's a lot of hands in that process. What if one of those hands goes away? What documentation is there around the process? In this case, there was none. And so it was always a chain of a telephone game. I was thinking about the strings and the cups that we played with as children of, can we really pass this message all the way down and come out with the same story at the end? How terribly inefficient is that? And that culture of risk is pretty evident by the sea of spreadsheets that they're swimming through. And that really leans into technology gaps. If you are developing your risk program in a sea of spreadsheets that is largely inefficient and fraught with risk of errors in reporting, where do you see technology gaps in that? If you have to manually aggregate the data, if it can't come out of a system, what if you lose that data? What if it ends up on a server somewhere, or even worse, on someone's hard drive, that I know still sometimes happens, and their hard drive crashes? So thinking about the inefficiencies of a hidden factory, the technology gaps of a hidden factory, and how that leans into a cultural and a strategic misalignment. So you may have when we have some conversations, you see these glossy strategic documents, these strategic plan documents that says, we will invest in technology. Really? Is that what you're doing? And so are you saying one thing and still actually perpetuating another? And so when we think about that culture and that connection, is there a misalignment in what you think you're doing, what you say you're going to do, and what
Actually do, right?
what you're actually doing? There was there was a presentation that we listened to recently, and so this is not original content, but I don't know who to attribute it to, so I will just take credit for that there. But there's the tone at the top, there's the mood in the middle, and then there's the buzz at the bottom. When you think about that misalignment, the tone at the top may say we have a firm strategy, we know where we're going, we know what we're doing. What's the buzz at the bottom saying? That really struck me, and I really latched on to that phrase.
I think that's great, and I think you indicated there, right? Some of those concepts, you can quantify, right? You can quantify, right, the inefficiencies and the technology gaps, and the fact that you may say you're investing in technology. I think one of the things we talked about in the Hidden Factory series was seeing a technology investment through to completion, right? And to your point about misalignment, right? You say you're going to do something, you start to do it, but you don't necessarily eliminate the old manual process. So you're not fully embracing technology, and so then you carry this cost. And I think that if we kind of tie this theme of allowing hidden factories to perpetuate to the culture of risk, right? If an organization is willing to allow those hidden factories to exist, then that's an indication that you don't necessarily have the controls, the alignment, and you haven't established the culture of risk that you want to. You might have said one thing, but you haven't followed through on delivered on that. So there's undoubtedly a cost then to not fully embracing and enacting that culture of risk and allowing those hidden factories to persist.
Well, and there's one other element too that I want to touch on. This has come up a couple times in recent conversations. I'll use the term failed implementation of technology, and you have the potential to define your own method of failure. But if you seek to adopt a technology, and if it doesn't really work, and it doesn't work in the sense that it's not adopted, or that it doesn't eliminate, as you said, you keep doing those manual processes, those hidden factories, the Excel spreadsheets. But what if it actually makes it worse? Do you have the right people in place to be able to leverage the technology, to be able to drive the change, and to be able to really make that process efficient?
So if you have a strong culture of risk, you're not going to allow those hidden factories to persist, and you're not going to allow them to get worse. And so you can come up with the ROI. And again, right, we won't go through that in detail. We covered that previously, but we can very easily quantify the cost of those hidden factories. And that's a way to measure and quantify the success of having a robust culture of risk. Let's move on from the question of efficiency and hidden factories into another dimension, which is the impact of risk on strategy at a financial institution. You have a really interesting specific example that we've talked about related to loan growth. Can you take us through that example?
Absolutely. And while strategies and goals may vary, from an institution by institution, almost everyone has a loan growth goal, right? You're not likely going to stay the same. Some people may actually have a goal to not grow. They're trying to avoid hitting a regulatory bump of $10 billion, and they're intentionally managing their balance sheet to stay right underneath that. So when we think about loan growth, it pretty much applies to everyone. So aligning your risk to strategy, using the example that I just shared of trying to stay under $10 billion, that's a risk, right? Because if you go over $10 billion, there are compliance factors that you have to consider. There are, costs of people and technology that you have to contemplate. So the impact on earnings would be a strategic perspective, be a strategic view to view that risk through. But if you're looking to grow, whether it's through acquisition or whether it's through organic growth, what are the factors that come into play? And I like to really dig into to look at this from a metrics and a data perspective, because you have some factors that are going to affect your ability to grow loans, and you have some factors that are going to be affected by your ability to grow loans. So thinking about loan growth. Let's look at four example metrics and where those might live within your organization. If you are a commercial real estate bank and you're trying to grow your CRE portfolio, do you have sufficient capital, or are you going to outgrow your concentration limits and therefore your loan growth is limited? If that's your market and that's your strategy, but you don't have enough capital to do it, you're not going to hit your loan growth goal. So that comes in from a credit perspective, because that's tracking, from a credit administration perspective, that's tracking your CRE concentration level. That comes in from a finance perspective. So probably someone in your finance department is calculating capital. Do they have the right inputs in there? Can they timely provide to the lending team, to the credit team, of, okay, put the brakes on. You're going to bump over a policy limit. You're going to bump over a capital policy limit or a capital stress test level. Are you okay there? That's gonna inhibit or potentially affect your ability to grow those loans. Do you have unfunded commitments that might pop you over those? So that could be favorable to you if all of a sudden you fund some of those unfunded commitments. That would help your loan growth. And so they're just kind of sitting there sleeping, off of the balance sheet, and all of a sudden you pop over. If you're trying to grow, that's a positive thing. If you're trying to not grow, that's a surprise. How are you managing that risk of who's going to fund and when? And when we think about charge-offs, if you're going to try to grow loans, when we talked yesterday about incentives, are you incentivized to put on good loans and to keep them and to have them funding? As opposed to, if you have to charge them off, then you have to go that much higher just to hit your loan growth numbers. So we have aspects of liquidity. Can you fund the loans that you need to fund? We have aspects of strategic from a capital perspective. We have aspects of reputational. Do you have the reputation in the market? Do people want to come to you? From a strategic perspective as well, what is the regulatory appetite of the relationship that you have and your ability to execute a merger if that's what you want? And can you execute on that? Can you align with that? Will you get the regulatory approval?
So all that is very quantifiable, right? It is clear that you can put metrics in place, and you can measure all those elements around that kind of that second concept, if you will, of tying strategy and risk together, and the culture of risk. Let's talk about one final example here of around shareholder value, and I think this is something that was near and dear to your heart and close to home, and how an institution, by embracing a culture of risk, can have an enormous impact on driving shareholder value.
Absolutely. So it was really fascinating. Starting out at my financial institution, where I ended that time as the chief risk officer before we were acquired, starting out in finance and really getting the chance to learn about the impact of the various numbers and metrics and how everything flowed through the entire institution, and then being able to be a significant driver of converting to a positive risk culture. Oftentimes, I think I mentioned yesterday, I was on the other side of the door in those conversations, but getting that door open, creating that culture of risk where risk is invited into the conversation to be able to drive, can we fund this loan? Should we fund this loan? Should we incorporate this new product from a retail perspective? What are the risks associated with that new launch? And being able to have those conversations from the board level all the way to the individuals who are processing the transactions in the retail space allowed us to be very closely in lockstep. And the ability to raise capital, were we able to grow the loans the way that we wanted? Were we able to fund them? Were they profitable loans? Were they going to continue to add to earnings, or were they going to present more earnings risks? Earnings drives value. And through making sure that we had enough capital, doing that full capital analysis on a risk-based approach, allowed us to grow to the point and to have that strong level of stability that we were attractive to a buyer, and we returned a significant amount of shareholder value in about a 5 or 6 year time frame.
And again, right, quantifiable, right, specific, measurable, right? As you said, time bound as well, so you can calculate an ROI on that. And I think that's a great example of really taking something that seems qualitative or conceptual, and really putting hard numbers on it. So I think that, right, we've got some really interesting. We talked about two sides of the same coin of risk and strategy. There's two sides of this coin here as well, around the the qualitative concepts and the quantitative ones. And I think that bringing those two together, really the bottom line is that the value of establishing a culture of risk within a financial institution has significant downstream impacts. And we appreciate your perspectives on what those downstream impacts can be, and then also what you can do upstream to help drive that culture of risk and create that culture of risk that's ultimately going to benefit the institution. So, Niki, thank you very much for the insights today. Greatly appreciate it.
Absolutely.